So you want to invest in real estate? Really? Welcome back to Confident Real Estate. I'm JC. On today's episode, we're going to talk about the 4 things that you must know, that you must do before you pull the trigger on your very first deal. We're talking about the specifics that are going to shut out the noise and distraction and all the yapping of other people who are telling you what you should and should not do and whether you're able to accomplish the goals that you've set for yourself. We're talking about building some confidence for you so you can go forward and do the right deal and not the rushed deal, and do the deal that's going to be right for your portfolio and your goals, so that you can go forward and pull the trigger when the opportunity arises, not watch it go by while somebody a little more seasoned and a little bit more confident seizes that deal that you know in your heart of hearts you should have taken, but you didn't have the confidence to take. And we're going to make sure that you're not staying up stressed out at night because you're second guessing yourself and creating doubt as to whether or not you should even have gone into contract on that deal, because in your heart of hearts, you know you didn't do all the due diligence or know everything that you should have and you rushed into that deal. So if you wait till you get to the end of this video and you watch it all the way through, we're going to teach you what those 4 basics are, and maybe one bonus 5th, that will get you into that right mindset so that you can do your very first deal confidently. And from there, the sky's the limit. So stick around. The first thing you need is money, cash, numero uno. The very first thing at the top of the list, number 1, money. You can't do a deal without money. No matter what you see on YouTube or what other people on the internet are telling you about 100% financing, that just doesn't really realistically exist right now. And that is a very hard deal to do. And if it's your first deal and you don't even know what you're doing in the world of real estate, that is an even harder task to pull off. So number 1, numero uno, cash, money. You have to have some level of financing to invest. It doesn't have to be a 20% down payment. You can go ahead and maybe get qualified for an FHA loan and do 3.5, maybe 5% down on a duplex or triplex where you're going to live in one unit as your primary and rent out the other 1 or 2 units that are there. It's possible. You just have to go out and see what's in the market. But you have to know that when you go out into the market, you should expect that you are going to have some money to put down. So start saving, throw out the Starbucks, focus on living below your means, and save your money. Grant Cardone, he's always on here on YouTube with his videos, and there's something he has said, although I don't agree with everything he said, something he has said that's very true. Cash is trash.
Cash is trash.
If you have enough money saved up for a rainy day and you have enough money to meet your expenses, live below that and save even more and invest everything you have. Don't take that excess money and spend it on material items like Louis Vuitton bags or fancy cars. That's garbage. Take that excess cash and savings and put it into investments, because that is the only way you are going to see that cash do anything worthwhile for you. Cars deteriorate and lose value the second you drive them off the lot. Fancy material items deteriorate and age, and then they're no longer in style or the fad or fashion. So don't waste cash on that. Put your money into investments that will continue to make you money. Every single dollar you have to invest is an employee, and you should expect that employee to come back with a minimum of 5 cents at the end of the year. When you get good, you'll expect your dollars to come back with a minimum of 10, maybe 15 cents per year. But until you get to that level, you should expect to create the mindset for yourself that every dollar you have is an employee who's going to go out and make you 5 cents a year. So focus on that mindset and understand that you need cash. Number 1, money, before you go out and find your first deal. So if you like the idea of your cash going out and making you more cash as your employee, and then that cash that it made you comes back and becomes a new employee that then goes out and makes you even more cash because you keep reinvesting it, then you're going to love what life looks like in the next 20 years. It is going to continue to build up, and you are going to be very wealthy at some point in your life. Just stay on that path. And if you like that idea, hit like on this video as well. It also feeds the YouTube algorithm, which I appreciate because I hear that's important. Number 2, where do you want to buy? You need to know your target market backward and forward. You need to do your due diligence. Do you know what properties they are currently sell for? Do you know what they rent for? Do you know the difference in rent between a 1-bedroom versus a 2-bedroom versus, say, a 3-bedroom, 2-bath with a backyard? You need to know that. Do units in that area typically come with in-unit washer and dryer? Or maybe there's laundry on premises. Or maybe it's a urban market and most people go to the laundromat on the corner. How far are you from the nearest laundromat? How far are you from the nearest supermarket? Do you know why people want to live in that community and what drives that community forward year over year over year? Do you know where that community is headed? Is it in an upward trend or is it in a downward trend? Do people live there because the school system's great? Do they live there because of the employment opportunities? Or do they live there because of the affordability and yet the ease to highway access and transportation makes it worthwhile? Those are things you need to know, and those things can change block by block. The amount you get in rent and the amount you can buy a property for may change block by block in certain neighborhoods, and you need to know why. And the best way to do that is to familiarize yourself with what's on the market, attend open houses, speak to local brokers, and get an idea of which brokers really know the market and know what they're talking about, and put your boots on the ground. Walk around the neighborhood a lot. Become very familiar with the neighborhood and where the new development is versus the lesser developed areas of that neighborhood. Why do people want to be in the south end of the neighborhood versus the north end? Is it because of crime? Is it because of transportation accessibility? You got to know that, because that is going to drive the end result of how good your deal is. You may buy somewhere that's maybe not as desirable as the key blocks in that neighborhood, but that's because there is a pricing out of people who used to live in those areas next to transportation. People in other neighborhoods may be moving in, and that may be driving prices up, which means that people who already lived in those neighborhoods, who couldn't afford to live in the better neighborhoods, now need to move a little further away. Are you ahead of that curve? Are you buying a property or properties in that area that is next in line and primed to be developed, and you will reap the benefit of it because you did your market analysis and you understand the market analytics, and you can ride the wave to that beautiful profitability as the area you bought into starts to become the up and coming area? If you know your market inside out, you can take advantage of those kinds of opportunities. Number 3, what type of asset are you going to buy? Are you buying a single family home? Are you buying a duplex or triplex where you're going to house hack? Are you buying a 1 to 4 family house where you're not going to house hack and you're just going to rent all of the units? Or are you going to swing for the fences and go 10 toes on the line and buy a commercial real estate property with over 20 units as your very first investment in real estate? Me personally, no way would I ever do that as my first investment. But that's how I'm built. I need to sleep at night and not wake up stressed out and panicked. You have to take the baby steps in. For most of us, you have to take the baby steps in. I do know people who have gone out and bought serious properties right off the bat and have been successful. They weren't without significant learning curves, but they were in a position to absorb those curves and not let them destroy them right off the bat. Most of us are not in that position, so I wouldn't recommend doing that. But you have to know what you're looking to buy. And the reason that's important is because of what's coming next. Number 4, lining up your financing. Have you spoken to lenders and started to line up where you're going to get your mortgage financing from? Have you spoken to local lenders who invest in the market that you're looking to invest and buy into? Have you spoken to national lenders who may also provide investment loans for people who are looking to invest in property? Or maybe you're doing a house hack. National lenders work there too. You have to know what kind of financing you qualify for. If you are somebody who has minimal money to invest and you think you're going to be able to get money from family and friends to help invest, you're still not going to qualify for a $2 million loan on a commercial property of, 10, 20 units. It's just not going to happen. you're going to have to start a little smaller. So that's why number 3, what type of asset you invest in, is so important to understand, because number 4 is how you line up your financing. Nobody's paying 100% of the purchase price in cash. And if you have the cash to do so, you shouldn't be doing that anyway. If you don't understand why, you should learn about leveraged financing before you start investing, because you're really not maximizing the returns you could be getting, especially with mortgage financing being so cheap right now. It just doesn't make economic sense. Anyway, that's a topic for another day. If you are going into urban markets right now, they are very distressed. All you hear about is people who want to leave urban markets. The pandemic, nobody wants to be in densely populated areas and closed confined spaces and apartments. They want rural and suburban living. Well, there may be an opportunity there because so many people are looking to sell their urban spaces that they may be willing to give you a deal that you wouldn't have got pre-pandemic. And they may also be willing to do seller financing, where they get a percentage of the cash up front from you in your down payment, and then you give them a note back saying, I will continue to make mortgage payments to you, and you enter into a mortgage with them so that they get a return. So instead of selling the property at a discount, they're selling it at a discount, but they're still getting an interest return on a mortgage that they're giving to you in the form of seller financing. So at the end of the day, they are going to come away with more than they would if they just sold it to you and you went out and got a mortgage loan on your own. That's something you may be able to negotiate with a seller. And that, although I said it's very hard to do earlier in this video, may get you closer to 100% financing. I don't know that anyone's still in a position to give you 100% financing, but you'll definitely maybe be able to put only 10% down instead of 20%, and then give the seller a note for the other 90% of the purchase price with an interest return, which means, again, at the end of the day, they're going to make more than they would if you just went and got a mortgage from a traditional lender. But that depends on what they're willing to accept and how badly they need the cash right now, as they, with so many thousands of others, flee urban areas and densely populated urban markets. Something to think about. Lastly, I'm going to give you a 5th bonus tip, and that is use common sense. It is so undervalued and underestimated, but common sense will really help you in your investing, especially the more you invest of your time and energy into understanding how real estate investing works and understanding the markets that you want to invest in. Common sense will develop what they call that gut reaction feeling that will help you stay the line and avoid possible problems as you go along in your investment journey. For instance, don't ask a broker for recommendation on somebody who can do an inspection. A broker only makes money on the commission when they sell the property. If you ask them who's a good inspector in the area, they're going to give you the guy that says, property looks great, signed off, and you're going to close. In fact, if you ask them who they recommend as an inspector for the property, make sure that person is on the list of people you do not call. It's a clear conflict of interest. That's using common sense. If you look at a property and you realize the property to the left or the right of it is in disgusting shape and deteriorating because the person who owns it isn't taking care of it, understand that any tenants of yours that come to live at your property are going to look at that piece of crap next to you and say, that's a little bit less attractive. And it may deter people from renting in your space. So either understand and accept that, or go buy the piece of crap property and try to get a deal and fix it up, because then you're going to get a greater return in the long run. Again, you make your money on day one when you buy. If you buy a good deal at a good price in good timing, you will make a huge return. And that is when you make your money. You don't reap the benefits of it and see it in your hand until you sell, but you will have it there in equity value on day one. Listen to your gut. Use common sense. That's my 5th tip to you. Consider that a bonus, but it should have been obvious. Anyone, and I mean anyone, can be a successful real estate investor if you're willing to put in the time to find the right deal and understand the market you're investing in. It really is that straightforward. If you follow these 4 steps I just laid out for you, you will go into your first deal with confidence and certainty and conviction. And that is a lot better, a hell of a lot better than going into your first deal with dread, paralyzing fear, and stress. Trust me, you don't want to wake up in the middle of the night and suddenly realize you should have done a lot more homework in analyzing the deal before you pulled that trigger. And now you're already invested and your money's on the table. That's not where you want to be. So get yourself prepared and get yourself lined up. As I always like to say, and I've said in many videos in the past, discipline will never lead you to failure. And the other saying I love is excuses will never lead you to success. And it's so true. If you do the due diligence and prepare yourself to invest the same way an athlete prepares for a game, you will be in a much better position to come out the winner. Hopefully you got something out of this. Hopefully you built a little more confidence. Hit like, hit subscribe, and we'll see you next time.